Hello and greetings from UB. On behalf of the Office of Alumni Engagement and the UB School of Management, we are delighted you are able to join us for today's presentation. My name is Christy Fields, and I'm the Director of Alumni Lifelong Engagement here at UB. I am so grateful you're able to join us today, and I hope you and your family are staying well. Since 1923, the UB School of Management has been developing leaders and making an impact on individuals, businesses, and communities around the world. In their mission to define the future of management, Dean Iyer has unified the school around 4 distinct areas of focus: business analytics, social impact of management, business of climate change, innovation, entrepreneurship, and leadership. Each of these initiatives are helping to realize their vision of a world of transformational leaders and organizations who change society for the better. With that said, we are excited to welcome today's featured presenter, Dr. Raj Sharman. Dr. Sharman is a management science and systems department professor at UB. His expertise is in artificial intelligence, patient safety and health IT, information assurance, including the use of biologically inspired computer security models, and disaster response management. He has published widely in national and international journals and has received numerous grants from the university and external agencies, such as the National Science Foundation. He received his PhD in computer science and a Master of Science in industrial engineering from Louisiana State University, and he received his bachelor's degree in engineering and a master's degree in management from the Indian Institute of Technology in Bombay, India. In today's session, Dr. Sharman will share how, in the aftermath of natural disasters, borrowers seeking credit from traditional sources such as banks may encounter higher interest rates than in pre-disaster periods. Peer-to-peer platforms offer an alternative involving individual investors, making decisions not only based on profit motives, but also empathy. Evidence over time has indicated that banks' post-disaster credit tightening is overly conservative, while fintech platforms, by including empathetic leaders, may facilitate the channeling of relief to those in need. Dr. Sharman will share more about the research surrounding these borrowing methods and how they affect minorities both positively and negatively. We will leave some time during today's webinar for Q&A. If you have any questions, you're going to see a question box on your screen, and chat those to us at any time. We'll save those for the conclusion of Dr. Sharman's formal presentation. In addition, we're going to record today's session and we'll send you all a copy within the next 24 hours. And now it is my pleasure to turn it over to our featured presenter, Dr. Raj Sharman. Welcome, Raj.
Thank you, Christy. Thank you. In this presentation, I'm looking at peer-to-peer and whether peer-to-peer lending and whether they impact, how do they impact minority regions. Before I proceed, I wanted to say that this is my presentation today is part of an ongoing research on ESG and the impact of environmental and social events on lending markets. It's also, this specific work is part of the doctoral thesis work for Loveleen Agarwal. Along with me, there are 2 faculty members. One is Christian Tew, who is the chair of the finance department and works with me here in the School of Management. And then Yuha, who is a professor of finance at Aalto University. Before I go further, I would like to express my gratitude and deep thanks to Joy, Rona, who's the engagement coordinator, Christy Fields, from who you have heard from her. She's the director of lifelong engagement, Caitlin McNulty, the senior staff assistant. I want to say these people, Christy, Joy, and Caitlin, have done a tremendous amount of work in bringing in faculty and other people to speak with you. And I'm really grateful that they asked me to speak to you. Second, I would like to mention about Dean Anant Iyer. He has been a very vibrant dean with a research focus, and he has tried to push us to explore how management research can impact society. my research incidentally was in that space, and so there was a concordance of ideas. Then, of course, I have talked to you about my co-authors, Loveleen Agarwal, Christian Tew, and Yuha. With that, I would like to start my presentation. And in choosing what to say, I had the option of making it purely a presentation devoid of academics. I did not choose to do that. I thought I would straddle between being much more practitioner oriented, but still keep some of the research aspects in it. I will go through those research aspects rather quickly, but it's there. My agenda today will include a brief introduction of fintech and P2P platforms. Then I will talk to you about the bigger question about my research. Where did I get the data? Some bill pay, because it's an academic presentation from a faculty member. So talk about some prior literature, but very briefly, I'll go to the analysis and finding and conclusion. I think you will like this research because it has some prescriptions of what people can do after a disaster, especially government organizations. So just as a way of introduction, and most of you may know what fintech is and P2P is, P2P platforms, P2P lending platforms specifically. So I will keep this introduction brief, but I will go through and highlight a few issues here. But before I get there, I wanted to make a couple of statements. We know and we realize, and there is past literature, quite a lot of it, and I will reference this line with prior literature, that banks typically tighten credit after a disaster for a variety of reasons. I don't want to get there, but they do tighten credit. So our goal was, is there a mechanism other than traditional banking that is available to people in general and for minorities when they need credit? Now, fintech. So yes, the answer comes from fintech. The answer comes specifically from P2P lending platforms, which is within the space of fintech. Fintech technologies are new relatively, and they leverage artificial intelligence optimization techniques and bring science and technology together. And the benefit is that they provide improved solutions, delivery of financial services. And that helps businesses and that helps consumers. Some examples of fintech are robo-advisors, which typically help you to optimize your investments and kind of invest for you if you wanted to, which is similar to investment apps like Robinhood, which makes buying and selling stocks easier. There are payment apps which you may be very familiar with. M&T and a number of banks use Zelle, PayPal, Venmo, Cash App. These are all fintech in the fintech space. Then there are personal finance apps such as Mint, YNAB, Quicken, Simplify, and a number of others that help you see all your finances in one place, help you to set budgets, make bills, pay bills for you. Then there are a whole group of apps that are called crypto apps, which allow you to deal with cryptocurrency, allows you to do keep wallets and pay from there. The NFT space is out here. Finally, there is peer-to-peer lending platforms, and there are a large number of these. Some of them are Prosper, Marketplace, Kiva, Lending Club, Upstart. They're not all the same because the governance rules are different and how they behave are different. For example, on Kiva, investors lend to borrowers without an expectation of interest rate. Prosper and Market and Lending Club and Upstart, they are platforms where investors go in to make money. So it's a for-profit platform, but it still helps borrowers. Since our research focuses on P2P platforms, I thought it would be good to mention that P2P platforms are growing very fast. The current market value at 83.79 billion, but that's as of 2021, slightly more now. But the projected amount is 705.81 billion by 2030, and that's growth rate for compound growth rate for 25.2%. That's the forecast. And typically, when investors go to the P2P platform, the expectation is that you would make between 2% and 15%, depending on how long you're willing to lock your money in and the type of loan that you invest in. At the max, there are stories of people making 36%, but then they will take high risks. Now, of course, every lending platform comes with risks and benefits. Our research, first the overview, it focuses on P2P lending platforms, specifically the lending platform called lendingclub.com, because we got the data from there for our hypothesis. Second, this research focuses on minority-dominated regions. How are lending platforms affected in minority-dominated regions after a natural disaster? We do have other research which we partition into separate papers that talks about lending after a disaster, and typically there is some pro-social behavior after a disaster in these platforms. But our focus was minority regions, so I'm going to focus on that specific aspect for this presentation. As I had mentioned earlier, minorities are unbanked or underbanked in the United States, and we have prior literature that comes from it. Typically in academia, we use an APA format or IEEE format to reference the source from which we got data. So since I've pulled part of this presentation from academic work, you will see, yes, there is a support for what I am saying. After a natural disaster, banks tend to tighten credit. This also had mentioned, but here what's new is that I'm trying to tell you that other people have researched and investigated this, and my statement leans on their work. And there is quite a lot of it. So I tend to believe that because they have papers published in good journals which have been very well vetted. So the question becomes, is there a mechanism other than traditional banking to address minorities' need for credit? And our research exploits a key characteristic of P2P lending in that it's not institutional lending, but individuals are making decisions to lend to other individuals or other groups of individuals. And when individuals make a different decisions, then both profit motive plays a role, but also business logic. Borrowers from minority region areas may face additional challenges in traditional sources. There are notes from a couple of prior researchers who have published their work of disparities in lending outcomes. That may be not by design, but the outcomes show that. So can P2P lending provide relief to borrowers from minority areas who have been exposed to natural disaster by offering lower interest rate? This is the question we kind of document and provide evidence for with our research. Our data, we look at, and using census data, we look at regions across the United States for the population breakup, whether it's white majority region or black dominated regions or Hispanic dominated regions. The lending data, and so we get the region characteristics that is included. P2P lending platforms give us the lending behaviors over a period of time, and we have about 10 years of data on this. Loans affected by disaster, we are able to pick up based on data from P2P lending platforms. So what we did in this research to bring you the results, the evidence that we are going to share with you. From FEMA, we are able to get the number of disasters, the location of disaster, and how much federal funding was made available to that region. And the federal funding also gives us an estimate of how severe the disaster is. From Lending Club, we get the loan data. From US Census, we get population characteristics, the average household income in that region, the population mix, which is very useful because we are specifically looking at Black dominated areas and Hispanic dominated, non-white dominated areas, and loan characteristics. As I said, we have our research actually spans beyond what I'm presenting here, but minority regions is the focus of this paper. And just to give you a sense of the data that we have the interest rates, the areas, the number of disasters, the severity rate, the borrowers, debt to income ratio, FICO score, loan amount, annual income, employment length, grade, purpose of loan, etc. We take all these variables and build it into the model. So I just wanted to give you a sense of that. In terms of the data that we looked at, we find that the total number of loans that are impacted by a disaster is about 122,000. And that's low severity, and 30,000 that is impacted by high severity disaster. There are 247 low severity disaster events that we examine. That is, severity is less than 500 million, half a billion. And then anything where the damage is above that, that amount is 13, the total adding up to 260 disasters that we examine here. The question we ask, can peer-to-peer lending provide relief by offering lower interest rates? Now, I know I'm repeating this, but I just want to re-emphasize it. Therefore, by design, I included some slides to repeat what I'm saying. And the larger question is, does empathy play a role? Does empathy matter? Do people exhibit pro-social behavior? And just an upfront, the answer is yes. People do forgo their earnings. And a few more things about P2P platforms before we go into the mechanics of our analysis. That P2P platforms attract all kinds of, even though it's a for-profit, they attract all kinds of investors, and some of them, and a large percentage of them, behave in pro-social manner and exhibit empathy, and not driven by business logic alone. And there is prior literature from psychology and other places that says, if you are empathetic, empathy leads to pro-social behavior. So that has been established. So we are trying to combine that to theorize. Even before we look at data, we should be expecting, and that's our hypothesis and conjecture, that people will exhibit pro-social behavior, even in platforms which are for-profit platforms. And P2P lending is large enough to make a difference. It is expected, it is estimated that it's about $68 billion as of 2019. We're trying to get more updated numbers. P2P lending does not require personal interaction with loan officers. That's another advantage, but only internet access. And when you say internet access, there may be some variation in the extent of internet access that people have across the country. There are some other questions we investigate when we study this matter. Does the intensity of disaster matter? Yes. The answer is yes. Does the frequency of the disaster matter? Here we study the number of disasters that have taken place in the same region, minority region, and what happens to the interest rate. I'm going to hold off on that answer. And does the type of minority region matter? That means, does the how do black dominated regions fare compared to Hispanic dominated regions? As I said, I have to pay the bills, I have to do some due diligence. So in our academic writing, we kind of cite past literature, which in P2P platforms, in lending, and people using lending data. Similar data has been used by other people in different research, but the second research by Liu and Gay, they use Kiva lending club data Kiva data, not lending club, Kiva, which is a very different platform where there's no interest rate that investors charge, and it's purely altruistic. Our platform is for business platform, and in some sense, our platform, our research is studying the impact of external shocks, and we look at natural disasters as an external shock to the system and what happens in minority regions after that shock. In another research that is not part of my presentation today, we are looking at social unrest, and in that we have studied cities and towns that were affected by Black Lives Matter, and how does the lenders behave in that context. That's a separate paper which has more nuances to it. In that particular paper, we also study the impact of media agenda setting and how they frame articles after the Black Lives Matter, and how does that impact lending behavior. We also had to pay due diligence, our academic currency here, for research on empathy and pro-social behavior. So we've looked at a lot of psychology literature that says empathy is a driver among human beings, and that empathy leads to pro-social behavior. So we are able to then hypothesize or conjecture that disaster-impacted loans in minority regions are funded at lower rates. This is our expectation from the theory point of view. And a subtitle under that would be P2P platforms allow empathic lenders to fund loans that are more pro-social in nature. These pro-social lenders fund loans at lower rates in the wake of disasters. We run a lot of regression because the staple for a lot of management and social finance research is statistics. And in our research, we use very rigorous econometric techniques to establish our results. We control for size of loan, borrower characteristics, and year fixed effects, so that we can remove the impact of the years, so we can get a pure understanding of behaviors after, and of course, a very condensed form of our econometric specification is here. I will skip it for the current purposes and go here, and I am seeing good results But what you see on the first row is that I have used a number of techniques. I've used linear regression. I've used a new technique called difference in difference, which is a much more rigorous technique. I've used propensity score matching and inverse probability. And you see the direction of the uh, values in the second row is all consistent. What I'm trying to say is that I have used many methods, and all of my different methods of analyzing the data point to the same direction, that after a disaster, people, P2P lending platforms exhibit pro-social behavior. That becomes clear. The R square is quite high, so the curve fitting is pretty good. And here are some results that we see in P2P lending platforms, for which we have used Lending Club. The drop in interest rate is about 2.6 to 4.8 basis points. Now, you might say, is this a lot? I'll answer that question. So the bigger question, are there alternatives to banks for minorities? Yes, there is. P2P lending platforms provide that option. It democratizes the process of allowing individuals to loan to other individuals. And a little bit of due diligence before I say some thing that we could do as a society. We did, this is all saying our results are robust. We used propensity score matching. You've seen these results. We get a 2 basis points, slight variation in it. We use inverse probability rating for a variety of reasons. I can explain why I use inverse probability rating, but probably for a more detailed presentation on that matter. Rates decline by a more conservative 1.8 basis points if I account for all of the issues that need to be accounted for missing variables and any selection bias. And our confidence interval is very good, exceedingly good, as you can see at the bottom line. Let me get out of this. So we investigated, do loans issued after a disaster have a higher default propensity? The answer is no, there is no significant difference. We tested for that. In fact, when we looked at after the loan, how many loans are there, we find that on an average, there are more number of loans after a disaster, and the total amount funded per loan is $74.96 higher with a solid p-value. We'll skip that. I asked the question and I did not provide the answer. What happens? We tend to look at minority regions as being similar, but they are dissimilar in a variety of ways. Here, we are looking at Black dominated regions compared to Hispanic dominated regions. After a disaster, Black dominated regions receive a lower rate than Hispanic dominated regions. That means Black, and we might hypothesize that this may be because Blacks have historically suffered, and the market, P2P market, is considering that and taking that into account. Now, I would like to add one more result, which is not on my slide, that the difference in interest rate actually narrows between white dominated regions and Black dominated regions. So the process of P2P becomes much, much more fairer. What happens when we have multiple disasters? Our interest rate and the evidence shows that there is something called disaster fatigue. And we are now documenting at what point does that happen. Now, One addition I would like to say is that in all our analysis, we looked at loans before a disaster and after a disaster, and we looked at how long does that lower interest rates last. And we found from our empirical evidence that that's about 6 months after a disaster that pro-social effect prevails. And as the number of disasters in the same region increase, that is a disaster fatigue. As the intensity of the disaster increases, there is evidence of pro-social, greater evidence that the interest rates are lower. So our work confirms that P2P platforms provide a relief for minority regions in terms of interest rates. Our going away prescription is that in minority regions after a disaster, it would be good if the local authorities provided information to the community that P2P platforms provide an alternative, and there is a lower interest rate to be had. So our research shows that even profit-minded people forgo some of their returns after a disaster. They do exhibit pro-social behavior. Now, what we can study is that when we look very specifically with regard to minorities, is that are the Black dominated regions in the north and the east and the south are the same? Are they the same? Because there might be a lot of differences because of the governance structure and the level of education that may prevail. So all Black minority dominated regions are not the same. In this, we take a broader stroke of Hispanics versus Blacks. And with that, I would like to open up the opportunity for people to ask questions, for my audience to, and I want to thank everybody here for taking the time to come and hear this presentation, and for the opportunity for allowing me to make this presentation. Thank you. Christy?
Very much for taking time today to share all the knowledge that you have, your expertise with us, that we are so grateful for the time you have given us. Just to start the Q&A session, again, everyone can chat any questions to us in the chat box, and we'll go forward with Dr. Sharman here. But Raj, the first question I have for you, when it comes to educating or messaging the P2P to minorities, how are they, being educated about this and learning about the availability to them?
When you talk about post-disaster, it might be better when we have an imminent disaster that is going to strike. For the government officials and people in authority and even the private sector to communicate, and for P2P platforms to communicate to the public at large. They could do that through a number of media that is available. Platforms do make money out of P2P platforms in addition to investors who are there to make money. So there could be some revenue to communicate that. Second, it could be a public service announcement as well. Now, how do you communicate in terms of message framing? That it's a whole body of research, but it can be done. Have I answered the question?
Yes, thank you so much, Raj. This next question kind of, I think, is maybe just piggybacks off that first question. If we're looking into learning more about this and continuing to educate ourselves, what resources would you say are available to us in regards to P2P and fintech?
Fintech is the larger umbrella, as I pointed out, and there are a lot of research papers, internet, and we offer a course on fintech. And perhaps our course could be taken, it could be offered at a time where it's available to people. We could also do some sessions on fintech, but there is a lot of literature and some books in that area on what is fintech. Google offers a lot of content on that, and what is P2P platforms. Now, there are many sources on the internet that provide this information, but want you to invest with them. And that information is also available to you. They also tell you about the advantages and the disadvantages and the risks that are associated with lending on P2P platforms, because nothing is really free. When people ask for money on P2P platforms, there's a variety of reasons why they ask for money, and the risk of that is also there. Now, when borrowers or lenders join any P2P platform, they go in and sign up, and the platform actually validates and the borrower and the investor in terms of their ability to lend or pay back, and collection of the money is typically done by the platform. So there is a small fee they charge for that.
Great, thank you so much, Dr. Sharman. And I know we spoke yesterday about some of the books you published, and I wanted to make sure we left some time too if you wanted to share those as well.
I have published about 8 books on information assurance, ontology, and e-commerce as part of it. But my main portfolio is to do research. I primarily work in the healthcare technology sector from the business perspective, and in the disaster management, disaster mitigation, and information assurance perspective, research. So these are the 2 streams of research that I follow, and I have about 150 conference papers and 71 journal papers in that space together, 8 books, and a bunch of grants. The books are available on Amazon.com, but I didn't want to bring it up because I don't want to kind of tell you that there's a commercial aspect to it, so I want to keep out of that.
Excellent. Thank you so much, Dr. Sharman. I think those are the questions that have come through right now. If anyone else has any additional questions too, feel free to reach out to myself, and I can connect with Dr. Raj Sharman for any additional follow-up communication. We're so happy to do that, and we're so grateful that you were able to spend time with us today. So on behalf of the Office of Alumni Engagement, the UB School of Management, thank you so much for taking time out of your day to talk to us a little bit more, Dr. Sharman. With that said, I want to turn it back to you for any closing remarks on your side.
I just want to say thank you. I'm so grateful. And I also want to say that in the School of Management, these days, data is very critical. Our research, and we provide evidence of, we theorize and provide evidence based on data. And we're very grateful to Lending Club that provided us data. And I want to leave you with one thought. If you would like to help faculty provide us data that helps different colleagues work with that data. For example, if it's related to supply chain, my colleagues in OMS will work with that. AI, we do. Fintech, again, I do, and Christian too, my other colleague with whom I do this work with. So we're always looking for data, and in any way you could help us, we would love to engage with you. We also do develop artifacts, IT artifacts, and if we can be of assistance to you in that space, we'll be glad to do that. Our primary goal here is to be a research faculty and then transmit that knowledge through teaching. And we offer a course in fintech, we offer a course in a number of subjects that are cutting edge. And we're getting there with AI and ChatGPT to improve productivity and looking at the pros and cons and the risks of that. Thank you very much.
Dr. Sharman, thank you so much. We are so fortunate to have you part of our UB family for all the cutting edge research that you continue to do and are doing. So thank you so much again for your time. Thank you all for joining us. Again, if you are able to share data, feel free to respond back to us at any time. The email that you receive tomorrow is going to also have the recording of today's session, but feel free to reply and share that data that Raj mentioned. We will make sure we get that over to the School of Management as well. So thank you all again for joining us. Thank you, Dr. Raj Sharman. Take care, stay well, and enjoy the rest of your day.
Thank you.
Thank you so much, Raj. Go Bulls. Thank you.